6 hours ago, Donald Trump looked into a camera and said two words that just rearranged the entire precious metals market. Very soon. That was his answer when asked about the end of the war with Iran. 2 words. And within minutes, crude oil dropped more than 10%. Gold slid below $5,100 an ounce. And silver sat frozen at $84, barely moving, as if the entire market was holding its breath. Now here is what every mainstream outlet is telling you right now. They're telling you the war premium is fading. They're telling you the safe haven trade is unwinding. They are telling you that silver at $84 is the metal finding its natural equilibrium as geopolitical risk exits the system. And on the surface, it sounds perfectly reasonable. War ends, fear recedes, prices normalize. Simple. Except it is not simple. And if that were the full picture, this video would not need to exist. Because while every camera in the world is pointed at Tehran, there is a second crisis unfolding inside a windowless warehouse complex in lower Manhattan that makes the Iran war look like a footnote. The COMEX vaults, the physical delivery backbone of the global silver futures market. And what is happening inside those vaults right now is something that has no precedent in the 50-year history of the exchange. On the first notice day for March delivery, the CME group recorded 10,526 contracts standing for physical settlement. That translates to 52.63 million ounces of silver demanded for actual delivery. Not paper settlement, not cash equivalents, real metal pulled from real vaults. The problem is that COMEX registered inventory, the silver that is specifically earmarked and available for delivery, sits at 86 million ounces. Do the math. 61% of the entire registered supply was claimed in a single day. And that is not a historical anomaly. It is the acceleration of a pattern that has been building for 6 years. Since April 2020, COMEX registered silver has collapsed from 240 million ounces to 86 million. That is a 64% decline. 154 million ounces walked out of those vaults and never came back. Not because demand dried up, because demand became so intense that the metal was consumed faster than it could be replaced. So when Trump says the war will end very soon, the question you should be asking is not what happens to the geopolitical premium on gold. The question is what happens when the fog of war clears and the world is forced to look at what the COMEX vaults actually contain, because what they contain right now is not enough. And over the next 20 minutes, I'm going to take you inside the data, the delivery reports, the margin mechanics, and the institutional positioning to show you exactly why $84 silver is not a price. It is a trap. The war everyone is watching is in the Middle East. The war that will reshape the financial system is happening inside the vaults. To understand why $84 is a structural fiction, you need to go back 10 weeks. January 1st, 2026. The day China quietly rewrote the rules of the global silver market. On that date, Beijing implemented strict export controls on refined silver. Not tariffs, not quotas. Full export controls, the kind a nation reserves for materials it classifies as strategically essential. And, in a single regulatory act, the traditional arbitrage mechanism that had connected the Shanghai Gold Exchange to the New York COMEX for decades was severed. Gone. Overnight. Now, to understand why this matters, you need to understand how the silver market has functioned for the past 30 years. When a price difference develops between two major exchanges, traders exploit that gap by buying cheap on one exchange and selling expensive on the other, shipping metal across the ocean to pocket the difference. This mechanism, called arbitrage, is what keeps prices aligned globally. It is the circulatory system of the market. And China just cut an artery. The impact was instantaneous. A premium of $8 to $13 per ounce opened on the Shanghai Gold Exchange compared to New York. In normal times, that gap would attract metal shipments from west to east until the prices converged. But when the world's largest silver refiner locks the door, the metal cannot flow. The gap does not close, it widens. And it sends a signal that the paper futures market in New York is structurally incapable of pricing. The signal is this: physical silver is not where the contracts say it should be. Then came January 29th. Silver futures touched an all-time intraday high of $121.62 per ounce. For a brief window, the market was actually attempting to discover the real price of silver under conditions of genuine physical scarcity, and the response from CME Group tells you everything you need to know about how this market actually operates. They did not let price discovery continue. They raised maintenance margin requirements to 60%. 60%. That means for every $100 of silver exposure, a trader needed to post $60 in cash. That is not a market mechanism designed to ensure orderly trading. That is a fire suppression system designed to destroy positions, and it worked. Within 8 days, silver crashed from $121 to below $64, a 47% decline, not because a single ounce of new supply entered the market, not because demand evaporated, because the cost of holding a long position became mathematically impossible for anyone who was not a major bank with unlimited balance sheet capacity. If this data is shifting how you understand the silver market, subscribe and turn on notifications. We break down the COMEX delivery reports every week with analysis you will not find on any mainstream financial channel. Now, here is what the margin hike was engineered to hide. During that same January window, delivery requests hit 49.4 million ounces. That is 7.2 times the level of January 2024. January is not even a major delivery month in the COMEX calendar. It is a minor month, typically processing 1 to 2 million ounces. In January 2026, the market demanded 49.4 million ounces of physical metal. Traders were not waiting for March. They were pulling silver out of the system immediately because they could see what was coming. And the metal they pulled did not return. COMEX registered inventory plunged from over 110 million ounces to 86 million in a matter of weeks. The vault doors were open, the forklifts were running, and the silver bars were leaving the building permanently. February followed the same pattern. 5,036 contracts settled for physical delivery, totaling 25.18 million ounces, the highest February delivery volume in modern COMEX history. The delivery rate reached 98%, meaning nearly every contract that remained open on first notice day resulted in someone taking physical metal. That is not a futures market anymore. That is a physical allocation mechanism wearing a futures market as a disguise. And then the bombs started falling. On February 28th, coordinated strikes by the United States and Israel hit Iranian military installations and leadership compounds in what the Pentagon called Operation Epic Fury. Iran's supreme leader, Ali Khamenei, was killed in the strikes. Tehran retaliated with ballistic missiles targeting American military assets across Kuwait, the UAE, Oman, and Bahrain. They struck the Ras Tanur refinery in Saudi Arabia, the largest oil processing facility on Earth. And they attempted to close the Strait of Hormuz, the choke point through which 20% of the world's oil supply passes every single day. Gold exploded. It broke through $5,400 per ounce for the first time in history. Oil spiked 30% in a single trading session. European natural gas jumped 46%. Global equity markets hemorrhaged trillions. The world was watching the Middle East burn. And silver, the metal sitting at the epicenter of the worst physical shortage in exchange history, did something that on the surface makes absolutely no sense. It crashed. On March 3rd, silver fell 15.8% in a single session, from 96.66 to 81.40. It was the largest single-day percentage decline since the Hunt brothers were liquidated in 1980. 45 years. The worst single-day drop in 45 years, happening during a shooting war that was driving every other safe haven asset to record highs. Gold up, treasury yields up, oil up, dollar up. And silver, the one commodity with a verified, measurable physical shortage, went down. Now either the market is efficient and silver was genuinely overpriced, or something else was happening. Let me show you what the delivery data says was happening underneath that crash. On March 3rd, 4,540 contracts were settled for physical delivery. That is 43% of all standing March contracts executed on a single day. The highest first-day delivery concentration in COMEX history. Let me say that clearly. On the same day, the price collapsed 15%. The largest first-day physical delivery in exchange history was recorded. Price went down, physical demand went up. Those two facts cannot coexist in a free market. They can only coexist in a market where the pricing mechanism and the delivery mechanism have been deliberately disconnected. Here's how the mechanism works, and it is elegant in its brutality. Step 1. A geopolitical crisis erupts, creating volatility. Step 2. The exchange raises margin requirements, citing risk management. Step 3. Leveraged long positions, the traders betting on higher prices, are forced to liquidate because they cannot meet margin calls. Step 4. The forced selling crashes the paper price. Step 5. Institutions with unlimited balance sheet capacity, the ones who can absorb 60% margin requirements without blinking, step in and take delivery of physical metal at prices 30% below where they were a week earlier. The public sees a crash. The insiders see a clearance sale, and the data confirms exactly who was buying. JP Morgan issued 99% of delivery notices during 1 week of January, through 1,624 contracts representing over 8 million ounces of silver. This is the same institution that paid $920 million in fines to the Department of Justice for operating what prosecutors described as a criminal enterprise inside its precious metals trading desk. Spoofing, manipulation, fraud. They paid the fine. They kept the positions. They kept the metal. And they are still standing for delivery today in March 2026 at prices that their own margin machinery helped create. Meanwhile, across the Pacific, the Shanghai Gold Exchange saw its silver inventory fall to 10.24 million ounces. The lowest level since 2015, both hemispheres of the planet are draining physical silver simultaneously. New York is losing it through delivery. Shanghai is losing it through industrial consumption and strategic hoarding behind China's export wall. And the paper price that is supposed to reflect this reality sits at $84, as if nothing is happening, as if the vaults are full, as if the math still works. It does not. Now let me show you the number that makes everything I have just told you converge into a single unavoidable conclusion. May 2026, the next major COMEX delivery month. As of today, May open interest represents 394.6 million ounces of silver, against registered inventory that, if the March drainage continues at its current pace, could fall below 70 million ounces by the time May first notice day arrives. That is a paper-to-physical ratio of 5.6 to 1. For every ounce of real silver sitting in a COMEX vault available for delivery, there are 5.6 ounces worth of paper promises. Now, historically, only a small percentage of futures contracts stand for physical delivery. Most roll forward or settle in cash. The typical delivery rate has been somewhere between 10 and 15%. But 2026 is not typical. January delivered at a rate 7 times above historical norms. February delivered at 98%. March opened with 43% delivered on day 1. The pattern is not ambiguous. Market participants are demanding physical metal at rates the exchange was never designed to handle. If May sees even 20% of open interest stand for delivery, that is 79 million ounces of demand, against potentially 65 to 70 million ounces of supply. The arithmetic produces a deficit, not a theoretical deficit, not a projected deficit. A deficit that would require COMEX to either find metal that does not appear to exist in deliverable form, or invoke emergency settlement procedures that would shatter confidence in the entire paper pricing mechanism. And the exchange knows this. They have already deployed every tool in the playbook. Margin hikes of 60%, cash settlement alternatives introduced for the first time, reclassification of eligible inventory to pad the registered numbers. These are not routine adjustments. These are emergency measures, deployed sequentially, each one escalating because the previous one was not enough to stem the outflow. Here is what most analysis misses. The silver leaving COMEX vaults is not being stored somewhere else. It is not sitting in another warehouse waiting to come back when prices are right. It is being consumed. The global silver deficit has exceeded mine production for 4 consecutive years. The cumulative shortfall now exceeds 800 million ounces. That metal went into solar panels, into semiconductors, into medical devices, into electric vehicle contacts, into the physical infrastructure of the modern economy. It was burned as industrial fuel, and no margin hike, no paper contract, no financial engineering mechanism can manufacture it back into existence. Here's the question I want you to sit with, and I genuinely want your answer in the comments, because this is the question nobody in mainstream finance is willing to ask publicly. If COMEX registered inventory has fallen 64% in 6 years, and delivery demand has increased 700% year over year, and the Shanghai Premium confirms that Asia is willing to pay $13 more per ounce than New York to secure physical metal, and the only mechanism preventing a delivery failure is margin requirements that make it economically impossible for most participants to stand for delivery, then what is the actual price of silver? Not the futures price, not the spot price. The price at which you can take possession of a real physical bar and walk it out of a vault. Because those two numbers, the paper price and the physical price, have already diverged. Shanghai trades $8 to $13 above New York. Retail dealers report premiums of 15 to 20% above spot for physical bars. And COMEX is settling an increasing number of contracts in cash rather than metal, which is the exchange's way of admitting, without saying it, that it cannot deliver what it has promised. The paper says $84. The physical market says something very different. And the gap between those two numbers is where the trap lives. So here's where we stand on March 10th, 2026. Donald Trump signals the Iran war is ending. Global headlines declare the crisis premium is fading. Silver sits at $84, and the financial media presents this as normalization, as a return to order, as proof that the system works and prices find their level. But let me walk you through what normal looks like right now. COMEX registered silver has lost 154 million ounces since 2020. 64% of its inventory gone. China has locked its refined silver behind export controls and is paying a double-digit premium per ounce to keep every bar on its own soil. The March delivery cycle consumed 61% of registered inventory on its first notice day. February posted the highest delivery volume for that month in modern exchange history. January processed 7 times its historical average. The exchange has raised margins to 60%, introduced cash settlement alternatives, and is reclassifying inventory categories to create the illusion of adequacy. And the drainage has not stopped. Not for a single month. Now, zoom out. Deutsche Bank forecasts silver could reach $100 per ounce by year-end if the precious metals complex maintains its trajectory. UBS cites structural supply deficits driven by solar energy, electronics, and electrification as forces that financial engineering cannot resolve. CBS News published an article last week asking whether silver hits $200 this month. Analysts who were calling silver overvalued at $30 3 years ago are now building models for triple digits. The consensus is shifting. Slowly, reluctantly, but undeniably. And here is what the consensus has not caught up to yet. The 4 consecutive years of global production deficits have created a cumulative gap of over 800 million ounces. That is not a number that gets resolved by opening a new mine, because new mines take 7 to 10 years from discovery to production. It does not get resolved by recycling, because silver used in electronics and solar panels is dispersed at concentrations too low to economically recover. And it does not get resolved by price, because the industrial consumers who need silver for manufacturing do not stop buying when the price rises. They cannot. Their production lines depend on it. A semiconductor fabrication plant does not shut down because silver went from $80 to $120. The silver content in their product is a fraction of total cost. They will pay whatever the market asks because the alternative is shutting down a billion-dollar facility. So the deficit continues. The vaults continue to drain. And the paper market continues to publish a number, $84, that bears less and less resemblance to the physical reality underneath it. When Trump says the war will end very soon, understand what that actually means for silver. The geopolitical fog that provided cover for the most aggressive margin-driven liquidation since 1980 is about to lift. The volatility that allowed institutions to take delivery at 30% discounts while retail traders were margin called out of their positions is about to subside. And when the fog clears, the market will be left staring at a set of vault numbers that tell a story the paper price has been trying very hard to hide. 86 million ounces, 52 million demanded in one day, a 4.6 to 1 paper to physical ratio heading into May, and a cumulative global deficit that grows larger with every solar panel installed in every electric vehicle that rolls off the line. The war in the Middle East may be ending. The war for physical silver is entering its most dangerous phase, and the $84 price tag sitting on your screen right now is not where silver has settled. It is where the trap was set. The question is not whether the trap springs. The data has already answered that. The question is whether you see it before it does. The empire does not fall when the bombs stop. It falls when the vaults run dry. And the vaults are running.